All right, I was told that we should get going, so welcome to this panel on early stage investment. We have a few very accomplished people here around the table, but just if people here do not know us, we should probably give a brief introduction. And I guess I can start with myself. My name is Camilla. I'm a principal at the Novo Holdings group. And Novo Holdings is a global life science investor with offices in the US and Europe and Asia. We do investments across different maturity stages. So we have our Novo Seeds group, which is where I sit. We have our Novo Ventures group, which you may have met some of my colleagues. And then we have our growth colleagues and principal investment. So in total, we have about 100 billion under management, and we make maybe $1 billion a year of investment into the life science space. Yeah, I guess I'll move it over to you, Craig.
Thanks, Camilla. Hi, I'm Craig Fox. I'm operating partner of Oxford Science Enterprises. Been with OSC since February. Prior to that, I've just spent under 25 years on the operational side in drug discovery and early development, including a CSO of Biotech for 7 years. OSC was set up in 2015 basically to be a startup generator in the Oxford area in the UK, particularly from the university. We invested about £500 million in that time, creating about 80 companies. And the vision really is to always start companies and then continue to fund them. So the theme of today's panel for all of us is particularly relevant at the moment. Great to see you all here, the hardcore of the conference. Dani.
Yeah, so thank you. Dani Bach, partner at ND Capital. ND Capital is a venture capital fund with offices in the Silicon Valley, where it was born 20 years ago, and in Lausanne, Switzerland, since 2019. We have about very close to 1 billion under management in 5 funds. We are currently deploying our fund 4 and also a growth fund for later stage opportunities. And most of what we do is early stage investments, including company creation from start, from academic projects that they may not have even a patent filed. We go there, talk to the scientists, try to imagine how to start a project. But we do also a lot of Series A, Series B, and of course we remain with the companies we invest as long as it takes. We have 3 verticals. We do invest in pure physical science, not relevant for this audience, but pure biotech, life sciences, but also things in the convergence between these 2 worlds. You may know companies like Twist Bioscience, world leader in DNA synthesis, is a company that we started from Series A, or Squeeze Bio in NASDAQ, also bringing engineering innovation into the healthcare market. And I mentioned that because first, there are not so many biotech investors that do that, and second, because we believe the market and the industry is going to move more and more into that convergence, but maybe we can discuss this later on.
Great, thank you. I'm Juliette today. I'm a partner at Forbion. I've been at Forbion for about 3 years, and before that I used to be at the Novartis Venture Fund, but which many of my ex-colleagues were here, but I was based in Boston, so doing mainly US investments. And at Forbion we invest along 3 strategies. So the first one is biotech only, so therapeutics, and we have our first fund is Biogeneration Ventures, and they do very early stage investments, spin out of academia type of projects. And then we have the Forbion Venture team, which I'm part of, where we do preclinical all the way to phase 1B, and that can be anywhere between seed Series A's and Series B. And then we have our growth team that we launched 2 years ago that does later stage clinical and crossover, which at the moment is not happening much, but also they can do public investments. We invest about 2/3 of our investments are in Europe and 1/3 in the US, and as I mentioned, therapeutics only.
My name is Michael Altorfer. I'm the CEO of the Swiss Biotech Association. As such, on this panel, a bit an outlier, because we are not an investor. We are an investment observer, I can maybe say. We cater for the startups and SMEs in Switzerland, what we call the external innovation hub outside of the multinational companies. You're talking about 1,200 companies, some 50,000, 60,000 jobs. And as an observer, We've been happy to see that over the last 10 years, the influx of fresh money into these companies has increased by about a factor of 10. We had 2 consecutive years of fresh money in the range of 3.3 billion in Switzerland alone. So naturally, as an observer, we see trends changing. We see how investors in the early stage phase and throughout the development of companies have changed their behavior, and happy to contribute that in this discussion. Thank you.
Hi everyone, I'm Pierre-Antoine Mudry, and I'm Head of Corporate Finance and Investors Relations at Rejuveron Life Science AG. We're a Swiss biotech platform, and we're focusing on finding cures for the chronic diseases of aging by acting on the very root cause, the very biological processes behind aging, so the so-called 9 hallmarks of aging. We have actually a pretty broad mandate in terms of how we can proceed. We can either create our own programs and wrap them into subsidiaries with teams of very entrepreneurial scientists running the programs. We can also take stakes, even in some case controlling stakes in companies that have programs which are relevant for what we're trying to do in the aging space. So it's a pretty broad mandate, which enables us to have diversification in a little bit the same way that a fund would have, but we tend to be more integrated. We have our own labs as well in the Biotechnopark of Schlieren, so a very diversified, effectively, biotech company.
Hi, my name is Stephan. I'm representing BaseLaunch today, which is basically an incubator to de-risk early science and build companies to a stage where they can then attract financing from the likes of Novo or Forbion, which both have invested into our companies. So the aim is really to get into a stage where they're ready for prime time. Now, we're Basel-based. There's many of these incubators out there. I think the special situation for us is we're doing this in collaboration with 7 companies, so 1 venture fund and 6 pharma companies, which they're our LPs, if you will, so they provide the funding. We do up to $500,000 convertible loans. Then the second thing is they're on our board to help us select the companies. And the most important thing is actually we have lots of access to their capabilities and know-how to really make good decisions on which companies we should look at closer, but then also what's really the next milestones to further de-risk the science. And we have lots of input from that. Plus, we complement that with our own diligence. And in this setup, I think we're quite successful in selecting new companies. They've raised around 450 million so far since 2018. And the average fundraise after us is, I think, 30 million. And we really particularly try to make the first money after us an institutional round that it basically can continue from there.
Great. So thank you for that introduction. I think it's great to have this broad panel because we can sort of share different views on how we see early investing and how it's changed maybe for the past few years. I think a lot of things have happened since the last panel, and it's always great to reflect in terms of, have things changed for the past 12 months? I think 12 months ago we had kind of a flood of money, a flurry of activity, and of course things now with the markets being very volatile and I guess the IRA in the US, there's been some significant changes, and some of these things you could say, well, does it really affect early stage investment because they're far away from maybe, well, at least in the therapeutic space, usually far away from commercial sales, and they are some years away from the IPO markets, but I'm sure that it has had some consequences in terms of what's needed for investments and the investment strategies around the table. So maybe if we go to the investors first, the first question would be, how the current market has affected the investments that you make and your investment strategies.
Mm-hmm. Maybe I can start with that one. Not much, as you said, because in therapeutics we are far from the public markets, but a little bit though, right? Because we have portfolio companies that are a little bit closer to the public markets. So on one side, on the early stage, we have been more focused these last months on company creation, as the one I mentioned before, really early stage, in which basically you are encapsulated from the general financial conditions. And on the other end, on the portfolio company management, what we have been trying to do is to secure enough amount of money for these companies to go through the storm and navigate through the storm for the months and years to come. relaxed.
Sorry, just to add to that, do you think you'll do less startups because you need that capital for the portfolio, or do you think you'll find creative ways to keep doing the same number of startups?
We do the same, and actually even more, right? Because because I say we focus more on company creation. They do not need a lot of capital at the beginning, right? We do a lot of seed investments, which we assume come with a certain amount of attrition rate, right? But at least this allows us to, to put bets and read the cards in the next months, 1-2 years to come. So it's an opportunity actually to do that exercise.
I just wanted to reflect on a couple of things. I think that it's a little bit different for like entering a new company and making new investments versus managing our own portfolio. And I would say on the management of our own portfolio, it's, as you mentioned, it's a lot of like cash conservation, making sure that you have enough capital to actually get through true value inflection point. And what I mean by that is that going to a next milestone is not necessarily enough now. Like the size of your data or the quality of your data package has actually, I think, increased when you talk to external investors. So, if you're in a completely new modality, completely new target that has not been validated in the clinic, if you get to an IND, it's great. But that's not enough. You haven't de-risked your investment at that point in time. So I think cash conservation is one very clear message that is throughout our portfolio companies. In terms of new investments, I think what we see, and actually this is true also for our portfolio companies that are fundraising, is flat is the new up. And so that's like if you're a really good company, I think expecting that maybe you're going to have your ESOP refresh paid for, that's a really great achievement. I think valuation had gone really, really very high in the past year, and as an investor, I'm not mad that those valuation are kind of like it's trickling down from the public market, but I do think this is something that we have to come to terms for as a portfolio company, but also as investors, that when we go out and raise, the valuation have inflated, and we all followed into it because we couldn't play if we didn't follow into it.
So just to pick up on the valuation part, because I agree with you that valuations have gotten more flat. And I think in Europe it may have been a little less inflated than in the US. However, we were seeing increased competition, and of course you have to follow. And I'm just curious with this Inflation Reduction Act, it's so new, right? So time will still tell what's really going to happen. But are you already beginning to see that in the valuations at the moment, or is it still sort of TBD in these a little bit later stage, early stage companies?
We see it very clearly. And actually now valuation, rather than being and looking for valuation increase to look nice on paper value in front of your LPs, now we take valuation as an opportunity to raise money, right? By lowering valuations. Because cash is king in times of crisis.
But I think the IRA, we haven't fully grasped yet what it's going to do. But I think, if you talk to big pharma, they're also trying to wrap their head around it, which is what is it going to mean, and are they going to move more towards biologics and away from the small molecules, and then what does it mean for the valuation of? So I don't think it has trickled down yet. Not to the full extent. I expect that there will be a change of strategy within the pharma on what they're going to do with their M&A strategy, and therefore it's going to trickle down in our industry. I don't know.
So maybe that's an interesting question to pose to a company. Are you feeling this pressure on valuations going down?
Yeah, I think we're absolutely feeling it in the sense that investors are definitely much more discerning and also demanding in terms of the valuations that they would like to get. What's also pretty clear is that some of the more generalist investors, or let's say newcomers to the space that had sort of jumped into the arena, sometimes on the back of, the euphoria of the new discoveries around the COVID vaccines, et cetera, have now either, run for the hills or are much, much more sort of like cautious in how they actually proceed. From our perspective, I would say one of the key change, of the way we approach is that, as I mentioned, we sometimes effectively just create our own programs and then wrap them into companies. we had traditionally be closed effectively to external investors into these companies, and the sort of new paradigm, if you want, and also I would say the shift towards probably let's say the pharmaceutical world. Let's say, we now have the big pharmas with perhaps, I think, the biggest ever cash pile that they've ever had. This is sort of like pushed us to change our tack a little bit right now. And for some very specific of our subsidiaries, we are now exploring potentially for the first time partnerships with either pharmas who are like very, aligned or interested in some of the, programs that we're working on, or even life science, let's say, funds that have, again, a very strategic potential interest into what we're doing. I think this has been an interesting change for us in that respect.
And what about the cash conservation that Juliette was referring to, and sort of making sure that you get really solid data packages to show your investors? How has this changed your buildup of your pipeline and the way you run the company?
I think, the first thing that we've done, and this has not actually been very fun, is that we've cut costs by 20%. And this is something that we, had actually anticipated that would need to happen. So this is something that we did actually as early as Q2 this year. And obviously this has been a difficult decisions to make, but ultimately, we saw that as a healthy way as well of preserving cash, and also of enabling, also the best elements in the companies to thrive. And generally speaking, we're definitely also more conservative and cautious as to, let's say, deploying into new subsidiaries. I think we're still open to doing it because, as people know, there's amazing opportunities in the market right now of companies to potentially invest into. So we have definitely not stopped looking at plenty of companies, but definitely I think the hurdle is probably higher in terms of getting investments or even sort of incubating programs. And what I would also add is that we probably tend to look more attentively or more closely at the potential compatibility of some of these early stage programs with respect to, interests with, let's say, pharma actors, et cetera. So we try to think a little bit more strategically around who could be interested into this program if we actually go, let's say, close to clinical stage or to early clinical. I think that was one of the key sort of changes as well.
And maybe going to the very early companies, how is it affecting the way you're guiding your companies to be successful with financing?
For us, it definitely didn't change anything. We've always been doing around 4 companies per year. We continue with that. So that definitely, and strangely enough, this year we've seen the biggest CSA ever in one of our companies, which was 50 million to Simaya. So that went fine. And again, the biggest seed financing, co-led by you actually, and Pureas into Engimmune. And also there's 2 more companies now which look to advance quite well on that angle. So we haven't seen any slowdown. And then also from the later companies, which we're kind of not that much in touch anymore, the CSBs and beyonds, I've just heard very good news on that aspect too. So it does not seem to stop. Obviously, yes, probably the valuation will be a bit lower. I think that is inevitable. But I think there's still money around if you have good companies. I would not be that worried currently.
So has it shifted the type of companies that are getting funded? And the reason I ask is because if you take the Novo group 2 years ago, we were all about this big bet strategy and big platforms and being very bold. And we are still bold and we still do platforms, but I think we have increasing key focus on value driving activities and assets that can really push the platform forward. So maybe less so trying to explore all the angles of a platform, but more focusing in. So a question to you is, are you seeing a differentiated or a different platform versus asset focus, or is it the same?
It's interesting you mentioned that, because the company I just mentioned you invested was a pure platform play, which was deliberately put into expanding the platform. The other one is also a very big platform. So no, but I mean, in the ending, we're not really looking. I mean, we look what comes in, and if it's interesting enough from whatever angle, and we think it's a very good science basis, we would. I mean, we don't really care what it is as long as we think it has a great potential to go on. So we deliberately have very little like predefined criteria of what we do and what not. I mean, I can only say the only thing we could never ever push through our panel, basically our board, is antibiotics. Everything else, we never had any issues. So far, no.
We have an antibiotic fund, so if you have antibiotic companies, just come to us. But maybe turning the question back to the investors again, platform versus asset focus. What are you thinking about that in sort of a cost-conscientious environment? I don't know who wants to go first.
We have been always very cost-conscious. I think it's a smart investment strategy, right, to get the greater return for the lesser cost. So on that line, we prefer asset-centric companies than platforms with no clear indication of where to go. But we have done platforms as well. Platforms in which it was clear where the platform was going in terms of the product, right? And more on the side of this convergence that I told you between the physical sciences and the life sciences. In those cases, a technological platform that would yield products for the healthcare market. But if you are talking about pure biotech, we are certainly favoring a single asset plays.
Yeah, we had a very similar strategy of, I think we have seen and looked at a lot of very exciting platform. And then also, because we're all scientists around the table, we would all get excited about the technology. But then ultimately the question that kept on coming back is it a technology that's looking for an application? And we don't want to be the ones funding how you're looking for the application. So I think along the same lines as what Dani was saying is, if you have a very clear application, then the platform is great if you can continue funding it, but it has to lead to some value inflection points, which usually you're going to be bought for your asset, not so much for the platform. So I think this has been, I would say, a consistent theme for Forbion, whether, in the ups and downs, so we continue with that. I have seen in the market, though, that the bigger platform that are looking for an application struggle a little bit more than the single asset. But on the other side, the single asset also have a lot of risk involved in them, inherent risk involved, and people want phase 2 single asset. I was talking to Craig this morning. We were saying exactly that, well, everyone wants to invest at phase 2, but then no one wants to invest from the preclinical to the phase 2. So that is a difficult spot to be in, and I also understand the contradiction that investors give to companies when it's like, well, still do that, but with which money? So.
Yeah, just to build on that, I was part of a company where we started 5 programs in drug discovery, and unfortunately did them all really well. So we ended up with 5 programs that were commercially viable, and we went from a phase where we were quite an acquisition target, where 2 of those programs were trailblazing, and then we became a target that couldn't be acquired because nobody would ever want all 5, and then that provides you with different strategic options to separate things out. So it's a real oxymoron, really, is you want diversification optionality early on. You don't want to just be a single focus, but actually it's very hard. I think as one of the other panels the other day said, when you get to phase 2, phase 3, you'll find it hard to find someone who likes everything you've got, and I think that's just one of the challenges. But I just wanted to add to what Dani, what you were saying is, and maybe Stephan can add to this as well. What we see, interacting with academics a lot is actually there's an awful lot of platform IP, less asset IP. The people who think they've got an asset have probably got a very early stage drug discovery program, and an asset needs to be created in the company because it's really hard. So we've sort of thought about this, and actually the opportunities that you mentioned, Dani, that arise from this situation, because there's a slight strategic shift, I think, in some investment, is actually we probably need to do more, because we then need to get something ready. We're evergreen, so we can take a bit more time, and then we can come to you both and say, actually, we have found that application for this platform. We've worked with the group, because actually, if we don't, there'll be, some of the best assets, of course, come from a platform that wasn't even looking for that asset, right? So I guess what we have to do as an ecosystem is just try and get that balance right, so that when everything picks up, the world looks different in 5 years, 3 years. Let's not pick what it is. Everything's ready for commercialization. I don't know, Stephan, you see this working with academics as well, mate?
Yeah, I mean, a lot of our work is, but honestly, it's either platform or assets, because single asset comps can also go into different indications, right? So there you almost have the same questions. And for us, a lot of our work is at this stage is really thinking with them and getting help of the external consultants and all these people to really define which are the good first indications to go for. And then it can, I mean, yes, the platforms are a bit hard, but also the single asset companies. I mean, there's hardly ever an asset which is just, you can just do one thing, right? So also there you need to think really hard on what's the first indication you go for, and then based on that, obviously, how do you translate it well with data? Yeah, I mean, for us, this is our daily business, I would say, and a large part of it is doing exactly this. And sometimes, obviously, it can go wrong, and then you need to regroup based on the data coming in. Sometimes it's right, but then, I mean, you just basically wait your way through, I would say.
Totally, and there is another aspect which actually, for us, is paramount, right? Is as soon as we decide on an investment, we are already thinking, okay, what is the route towards the exit? And what is your exit goal? It determines many things, including how are you going to build up your company. Is it going to be a very wide company because your goal is an IPO, or is it going to be a very precise, surgically focused company because you know that your buyer is Novo Nordisk, for example, right? And you need to provide what they are looking for. And this has to be clear from the start.
But then I guess the question back to you is, given the public markets and the buyer landscape, hasn't that changed somewhat in terms of how you can design that? Because it's not the same as it was a year ago.
Very true, very true.
We think a lot about what if you have to run the next trial. So I think that is a very important question for us, because let's say you have a compound that is very, you have great preclinical data in RA, the biological rationale is really impeccable in RA. You can run your phase 1, you can run maybe a phase 1B. Do you want to run the phase 2 on venture capital money, and then a phase 3 on venture capital money? This is a lot of capital to put to work, and so I think, in the investment thesis, we do think a lot, okay, maybe the hypothesis is that pharma is going to be interested at that point, phase 1B, but what if you need to actually do the phase 2? And so that is the consideration of the amount of capital that is needed and which application you're going to go for is actually really important. So maybe you need to think about, okay, maybe it's good for RA, but it's also good for another smaller indication where you can define the stratification of your patient better and run a smaller phase 2 trial where you can show your efficacy in a different indication, because RA is very difficult to run trials in. So the next step, even if it's not within your Series A or Series B plan, the step after is very important, because raising 350 million is going to be very difficult if you don't have access to the public market.
Yeah. And I think we have the same opinion, right? And it's also, you have to design your project, and you also have to understand if there's a pipeline in a project, or if there's whether you want to partner certain things with the big guys, and then you do some in-house projects yourselves, where it's more of a smaller indication that can be actually accomplished with VC money. I think those are all the thoughts that are going through our minds, at least. But I wanted to, Michael, as a sort of I guess not outsider, but a representative of all the companies in the area, in Switzerland at least, and being in the pharma hub, you have a lot of strong players there. Are you seeing more activity for pharma, for wanting to maybe acquire early or things like that because of these lower valuations? Is that something that you're seeing?
I can't say whether we can already talk about the trend, and the overall picture, I think, is remarkable and quite unique. If you think of it, we have gotten a maximum amount of more than 3 billion fresh money in Switzerland last year, the last 2 years. Probably pharma has the biggest possible liquidity reserve ever. And also many of the funds have actually been doing very well in fundraising in the last 2 years. And then you have a gloom and doom situation, in particular in the US, which I was really shocked when I was in San Diego at the Bio US. You would think like the world is collapsing. And yet, we observe what Stephan has said. We see no slowdown, if not even an acceleration of creation of new companies. We have seen also during COVID that the investors did not hesitate to put up the additional cash to cover for the delays. And as long as you believe in your asset and the development and your management team, of course. Mm-hmm. Nevertheless, it's clear we do see a reduction of valuations, although in Switzerland this is much less pronounced, first of all, because Europeans tend to have lower valuations in these cycles anyway, and Switzerland in particular, we have 96% of the companies that are privately financed. So the private financing sector, again, is a special breed and maybe a bit more sheltered from these larger swings. Inside of that reduced valuations, we see, a bit more cautious on the cost side. We certainly see that one wants to be careful about big investments, starting big investments. But it's also natural that at this point you reach out more to the pharma side to do collaborations. It's less so the M&A transaction to really sell that we see accelerating, but we see more talk on really setting up research collaborations or a teaming up of pharma and investors to provide the funds together.
Yeah, I think it's a really good point that there was a lot of strong VC fundraisers in the past few years, and that money has to get some legs to walk on, right? So I think from our end, we continue to build new companies, and we're not really seeing a slowdown in the activity of people being interested when you have quality. But coming back to the quality and the solidity of data that you mentioned, Juliette, I think it's becoming, I mean, it was always important, obviously, to create the right data packages, but it's just putting more and more pressure in terms of having more maturity in the packages that you propose. On the other hand, I think we also have a willingness to bet on people that we know can execute, and that so it's not only the assets, but also, of course, the quality of the management that we look at a lot, and the two things together add up to the value generation that we need to see. So I just wanted, I mean, we have more questions, but with 17 minutes left, I want to make sure that we capture any questions that might be in the audience. So if anybody has any burning questions, please raise your hand. And if not, we'll continue. Doesn't look like it. Okay, well, interesting conversations we have, or maybe not at all. Okay, so maybe, I think we talked about this a little bit, because it comes down to investment strategy as well, but just to try to ask in a little bit of a different way, the appetite and model for building new ventures, has that changed for you? And maybe we can start with BaseLaunch.
You mean for us, or how we think about the ones after us? Because for us, certainly not. No, we're not organized as a fund, or so to speak. We don't have the 10-year cycles. All these things don't kind of come into place for us, or no, not yet at least. Unless some of our partners will decide to change strategy and just do very late stage stuff, then maybe. But I think that's the general notion of, I think, honestly, to answer the questions of what we're trying to answer now, you will have to regroup in 2 years again, and the funds have to refinance themselves, the ones which are not an evergreen one, to see how that's going. I think that's, like, if the market continues to go down, then yes, I think we'll have an issue in 2-3 years, but not yet. So, and again, for us, it really did not change much so far.
I think if I just add a bit to that as well, I guess the thing for us that's changed is thinking about new co's that were formed maybe a year or 2 years ago. Obviously there's a plan there at seed, and then there's a vision of what Series A will look like and Series B. And I think there is a bit of a knockdown effect on, as Juliette was hinting at, of what that package or what the status needs to be at Series A and B versus that original plan. And I think that's where, we're going to have to do a bit of fixing there. Are we going to add a bit more capital? Are we going to have seed extension? What mechanics are we going to have? Because there is, the syndication, people do different things at different times, different preferences. And so some things are not going to look as attractive, even though they're just as good as they would have, 3 years ago. And that has a knock-on effect, I think, if you then go right back to the beginning to a degree of thinking about seeding something. You either have to say, well, I've sorted all that out in 3 years, so I can go back to that mentality. I'm not sure that's quite right. I don't think you have to be as pessimistic as it might look today for an existing co. So I think then it's just about trying to find a halfway house where, you know, you can't have your cake and eat it actually at Series A anyway. You know, the whole point of Series A is we've just about found out what we've got. Now we need to go and get on with it. But I do think, you know, getting the high quality investors coming in either then or at Series B is a consideration in strategy that has changed a little bit.
In our case, what has been changing, so taking account that our Fund 3 was announced at the end of 2019, so just before COVID kicked in, and basically what has happened is that we, the Europeans, have taught the Americans how to do things lean and cheap and vertical and low valuations, quick and effective, right? So
Still as good though, yeah?
Yeah, they have a lot of things to learn. Before the European team started ND Capital Europe, our American colleagues were doing the classical US way, right? So big Series A, big companies with a lot of people, and big is nice, right, in the US. And then we started doing things like we do in Europe, right, and what we have been doing for many years. And COVID came in, and they saw the value of that, right, to be more lean and focused. And now they are copying us.
And definitely, if I can add something as well to this on this topic, you know, we've definitely with some of our conversations with funds, we don't necessarily see a drop in the appetite in actually, you know, incubating or seeding, because, you know, some of the return potential can actually be gigantic if you do it well. And another point which also, you know, is actually probably a good thing if you're actually thinking of doing that, is that we actually see the, you know, the sort of like race and the cost of talent also going down, right? Which is interesting. I remember, you know, a couple of years ago when the market was in an absolute frenzy, how difficult it was in some cases to hire, you know, some of the important profiles that you need. And this is something that has changed, which is helpful.
I do think though that as a company, at the moment, if you're fundraising, and obviously if you have the choices, I think it's very important for the company to figure out who they're fundraising with, because if you think about where the money from venture capital comes from, there's a lot of the LPs that, you know, have allocation for venture capital and then for other stuff, and usually the venture capital is a pretty small part, and they have a limit as a percentage of their total allocation, and all the rest is public. Because the market has shrunk so much, then immediately the venture capital allocation went high, very high, and they need to reduce it. And so maybe now, like all the funds that have raised capital in the next 2 years, their pockets full of cash, but what is it going to be like to fundraise money for venture capital to actually get money for the next fund and the next fund? And so I do think that this is something that as a company, you know, hopefully you have the embarrassment of the riches, and you can choose the venture capital the fund that you're gonna work with, knowing who your fund is, knowing where, you know, what their performance is, what their historical performance is, where do they stand in their fundraising, and all those kind of things is going to be a very important thing, because you don't want to find yourself into a situation where your investor has basically folded. They can't have the rest of their capital. So it hasn't happened much yet, but I do like, I've seen in the US, I was talking to some colleagues in the US last week, 2 funds that I know of that were first-time fund have folded. So, you know, this is the type of thing that I think as companies you have to think about over the next couple of years.
Yeah, and then that of course also ties into the limitations of some funds to do follow-ons, right? So you need to make sure that you're with investors that can actually take the long haul. And of course it's not always easy to get the top tier investors, but really just selecting the ones that'll take you the furthest is of course a very important consideration to make. I think we have a question here.
Thank you, Victoria English from Mednaus. I'm trying to put myself in the position of a European company that listed on NASDAQ within the last year and a half, and now has a valuation which is below my cash. What do I do? I mean, in other words, I know what I want to do. I want to continue developing the product. But what are the intermediate steps that I should take besides conserving cash? What are the intermediate steps that I should take in order to survive effectively and to get my product further along the pipeline? There are quite a few European companies that listed on NASDAQ in the last 12 months that are rather immature in terms of their portfolios.
So, yeah, so if you're a public company trading below cash, that's a good opportunity to sell. But if you don't want to sell yourself or you are not going to be acquired, basically what you have to do is to invest this cash precisely to grow your portfolio and mature your portfolio so that you are less of a acquisition prey and more of a more mature company, well equipped for the future, I would say.
Yeah, I think there's some maybe creative financing of some kind of mergers that you know, which we have seen in the past couple of years of, you know, companies that have infrastructure, companies that have assets, they kind of merge. So I think the merger is probably something that is an obvious solution. The other part, I think, is obviously the M&A, and I think that's going to be, it's a great opportunity for the pharma, and I don't understand why they haven't acted. They have their coffer full, and they haven't acted on. Some of those companies have pretty decent assets, and now the valuation, even if you give 2x on their share price, you're barely paying more than cash. So that's a pretty good value for their money. So I don't know why they're not doing that. And then maybe another aspect that I think we're going to see in the market is probably a lot of secondaries and taking some of those companies back private.
So Juliette, for what you just said is very interesting, because indeed one wonders how comes that these companies are not acquired, right? And the answer to that is very important for every company that is thinking to sell to pharma. The answer to that is that actually when the pharma acquires an asset, it's not only spending the money that costs the asset, but it's also putting a lot of money at risk in further development of that asset, right? It's a lot of cost that they will have to incorporate and put. And I think this is important not only for those public companies, but for every single private company thinking on, okay, who's going to be my acquirer? What are the criteria for me to be a good acquisition target? And this is a very important one, right? So the liability that an acquirer takes by acquiring you, it goes much beyond the money they pay.
Yeah.
But I think an additional consideration is partnering. It doesn't have to be acquisition. So we, for example, Spiro is an antibiotic company that just did a deal with GSK. I think it was announced today or yesterday. And they, you know, they were really down and still had cash in the bank. And so, you know, partnering is one of those ways where you can actually get some non-dilutive funding in and help extend your cash way. But I think coming back to the being cost conscientious and cutting costs, maybe, I mean, unfortunately, you probably, there's no short way. I think our companies, we had 2 companies list in the past, a year ago, you know, something like that, and they are down, and we were lucky that they have enough money to sort of bridge them through the big data points, and of course that's the main deliverable. Just make sure you can execute on those value generating milestones, and then try to be creative in terms of, you know, other sources of funding.
I'm just going to add, I think there's an intrinsic conflict which is part of the reason why things haven't happened that we expect. You know, you made the point, a lot of these companies, not just European, US as well, went too quickly to IPO. What that probably means is they've definitely got something, a lead product that looks tangible, looks real. And then the second thing is quite far behind. The ideal scenario that Camilla's just talking about is you partner the second thing non-dilutively, get some capital, you can refocus your finance on the first thing and push that ahead. But the farmer's going to be interested in your first thing, not your second thing. And then you've got this tension between, do we sell out too early to you know, maybe we can ride the wave a bit longer, maybe some of the investors think that, maybe some of the management team are seeing that, and then I think that also feeds into why we've not seen the consolidation that needs to come, you know, because you know, I've been in a lot of mergers or nearly mergers, and valuation is always the biggest problem, you know, getting people to agree, and if it's 3 parties that's even harder. And so I think that's the trouble, is the sort of answers are obvious, but the path to getting to the answers is really difficult. So maybe we're waiting for a bit of an uptick in the valuation, so then people sort of, the scales start to tip a bit more. Maybe some things progress a bit more, and then suddenly that conversation about partnering one asset, keeping one, looks a bit better in the mirror. That's why I think it hasn't happened.
Yeah, there's another question down there.
Sorry, I made you walk along. Ryan Benedict, Latham & Watkins. One of the themes that's come up just here, but also on the prior columns or the prior panels, is this idea that the great falls in the public markets and public markets repricing sort of hasn't affected or hasn't been seen in the same way in the private markets, and a lot of the panelists have talked about that. But how does, I mean, one of the things that was talked about is the public prices putting sort of a cap on private valuations. Can you talk a little bit about how you think about doing early stage B rounds, C rounds, and whether or not you take into account or think, oh, well, there's a similar technology over here and it's trading below cash. I mean, do you think about those things in your valuations, or is it still business as usual?
I'll say one thing, that IPO for us is not an exit. It's a financing event. And so while it might be a good indicator, when we think about the exits of our company, we usually think about actual M&A of comparable companies, and that's the more important valuation. If there is no other comparable, then we will look at what's happening in the public market. But I would say we also very much realize at the moment that this might not be the true reflection of what the company is worth. But that being said, if that company is public and being bought, if you do 3x on not much, it's still not much.
Yeah, same. I don't have much to add, actually.
So I guess my point is that so then if you're doing a Series B in a similar company, you then think about, you sort of recalibrate the value of the Series B because of what you see in the public market?
Well, I think there's two aspects of that. Is the exit potential, and obviously recalibration is going to happen on that side. But there's also the fact that, well, we might not get access to public market, and therefore we're going to have to raise yet another round in the private market, and therefore you keep on increasing the value, like the amount of cash that you put into that company. So you have to take into account additional rounds before that company is going to be acquired, because also pharma is buying later because they want to delay the risk and all those things. So I do think that it hasn't fully shaken up yet, but I actually think it's coming.
And another effect is that the M&A values are lower because you cannot present alternative for the IPO, right? In some occasions, you don't have this optionality.
Yeah.
I think for the right companies, there is still opportunity in that market. But so we have a few companies that are, that are sort of alone in their space, one could say. And I think for those companies, we are still seeing that interest, and investors that invest in the cross rounds and stuff like that. I mean, they will do that, but it is because they have a very different profile and de-risked in many ways, and sort of not another fish in a really, really crowded pond. So that's at least something one could think of as well. Any other questions? Yeah?
Richard Scarrett. I had a question. A lot of this conversation seems to have been predicated on IPO, whether as a fundraising or as an exit, both in this panel, which is an early stage investment panel, and also in earlier panels as well. Do you think that there's always been a general assumption that an IPO is an exit, which, as Juliette said, is actually a fundraising? Do you think that the current market conditions will perhaps persuade companies that they need to be more strategic in how they're thinking, rather than just have an assumptive exit that they can easily say, oh, I'm heading for IPO in X number of years?
Well, I can take a go at that. I think you always have to be strategic, because as my fellow investors here are talking about, you do want that real exit, right? And if you're not planning to do that, then you really have to own the entire path to the market. because, as you say, you need the money to get all the way through, and that might be very, very hard to do on you know, a smaller VC investment. So I think the strategy either has to be, you know, very acquisition driven, or you know, you go to market in a smaller tangible indication where you can handle a lot of that commercial aspects as well.
Maybe one of the things that I would add as well is that, you know, obviously the IPO is always still a path. You always need to be strategic, as you mentioned. I think one of the key considerations is that people will, if they go public, will tend to go public at a later stage. And the sort of like trend of having preclinical companies IPOing on NASDAQ, I think, is dead, at least for now.
I think that's not only bad, honestly. I mean, I think in the last few years, we've seen quite a few companies going public, which should have actually not done that one. So I think, I mean, not saying too much, but I know also one of our comps were thinking about that, and they just cut it out now, and prefer to develop a bit more currently under the radar of the public investors, which I think is a good thing too.
So one last comment, because we're over time. Dani, if you're burning, you look like you're burning to...
Yeah, well, I'm going to be a little bit blunt on that one. So for us, an IPO is a failed M&A, right?
Yeah.
A failed M&A. Because we are in a market in which pharma are dying to replenish their pipelines, right? And to go through patent cliffs, etc. They are very, very good at marketing drugs. That's what they do. They excel in that job. And they need to buy drugs, right? So as an investor and as a founder, when you start building up converting your innovation into some product, well, you have to wonder very seriously, how comes that I'm not getting bought, right? If the thing was good, it would be bought. And then if you cannot sell it, ultimately you end up in an IPO, which is a nice way to raise money and to keep going, right? But that's certainly not the goal, at least not for us. It's not the primary goal.
Okay, on that remark, I think we're done. We are out of time, so thank you very much for attending, and hope to see you out there. And if you have any questions, feel free to walk up to us. Thanks.
Thank you.